morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Shah and you're watching Indian Open. It's an important day of trade. It's the day of the RBI policy, and therefore, maybe ahead of the policy, the markets could be quiet. But during the day, expect some fair bit of volatility. If not anywhere else, then in the banking space. But let's start off with the headlines at this hour. 41 out of 43 experts expect the 6-member policy committee to cut rates, shows the Bloomberg poll. Jet Airways lenders will infuse 1,500 crores only after existing promoters Naresh Goyal and Etihad have pledged part of the stake in the company. Nearly all of the loans advanced by IL&FS lending arm have turned bad, says the government-appointed board. The US is all set to lay down a 2025 target for China as the two nations aim to end the trade war. That is a Bloomberg exclusive. But let's take a look at the trade setup for the day. There were a lot of news flow surrounding what will happen between US and China. Not that it had a big impact on the markets. We'll come to the news flow in a bit. First, the markets. And the US markets had a quiet day. By their own standards, it was a quiet day. Nasdaq may have been 0.5%, but S&P and Dow about 0.25%, less than 0.25% by the way. So a quiet day. Europe in its own sweet way was a lot more active intraday basis than US was, as those rates show as well. But US quiet. As we see what's the impact on the Asian markets, again, very, very quiet for the Asian screen as well. Hang Seng marginally in the red, Shanghai about 0.9% higher, Nikkei about 0.25%. So all over the place, but largely quiet. And the SGX Nifty indicates that too. A quiet start, but a start in the green, which is quite interesting, because based on the trends yesterday, a few people would have thought that maybe there's some more downside. Speaking of trends that happened, just take a look at what's happening across the spectrum of options, and you will see that traders are now placing their bets across the spectrum. So max OI at 12,000 call, max OI at 11,000 put, but there is also fair bit of OI build up on the 11,500 put. So traders are hedging their bets across the spectrum, and I wouldn't blame anybody. I think this month could be very, very volatile ahead of the crucial election result, because the elections get underway and news flow and sentiment surrounding elections could well have a big impact on what the index does. What else is having a big impact is crude. Not that it had a big surge in trade yesterday, but this is just an example of what crude is doing. And that highlighted portion on the chart is how the movement of crude, which is the purple line, is impacting the movement of oil marketing companies, which are the other three lines, which is the yellow, blue and the pink line, and that's BP, HP, IOC, and how in the last 6 or 7 trading sessions, when crude has shown that meaningful spike, it's having that impact on the oil marketing companies. There could be other reasons as well, but certainly there has been a bit of a pullback in the oil marketing companies with the rising crude oil prices. So that's something that you got to monitor. Crude will not only have an impact on what happens to individual stocks, but also on sentiment surrounding the country. So keep that at the back of your mind. That is that one key monitorable. FIIs for the first time in many days, though you would argue that there was a small 50 crore sell number on the 29th March as well, but a large number, sell number, the first time in a really, really long time that we've seen this. Let's not create alarm bells out here. This could well be a day's phenomenon, or maybe a short-term phenomenon before the ETF money returns to its normalcy, which has been on the positive side the last few days. But maybe people are taking cognizance of the valuations as well. And even that is debatable in Rhythm Desai's words. But a sell number coming in from the FIs in the session yesterday, though I repeat, this is not a cause for alarm bells at all. We'll watch out for these numbers going ahead in the next few days as well. However, amidst all of this news flow and before the policy, there will be some stocks that you got to monitor ahead of the policy outcome, which is at about 9:15 when the markets open. Which are these? The 3 or 4 that I thought were important. I'm just bringing them out to you. Firstly, Indiabulls Housing Finance. They've given their FY20 guidance, and they've said that they will deliver about 17 to 19% PAT growth. For that size in a year when there have been some issues, I don't think the number is looking too bad. Let's wait and watch how the market reads into it. Nalco and their guidance, their FY19 net sales, they've said will come in at 11,397 crores versus 9,376 crores. So another stock which could have a bit of a reaction in the session today, you never know. What definitely should have a reaction is TVS Motors. They're an investor day, and they're betting on the scooter segment. They're saying that the recent slowdown is driven by the weak urban demand and discounts, but they're talking about how they can surpass 40% segment share of the domestic two-wheeler market. Brokerages have come out with their views on TVS Motors post this investor day. Details that came out, Goldman Sachs very upbeat amongst others about what's come out from TVS Motors. So do watch out amidst all the talks of turmoil within the auto space. This is not a bad outcome. I would like to believe that. So let's wait and watch what happens to TVS Motors in a session today. Rate sensitive, so well, could have a different reaction as well depending on what happens in the policy and otherwise. But at 9,915, maybe just maybe TVS Motors could be sanguine. Last one, and not necessarily on news alone, but something that I would watch out for is Zee Entertainment. One would have thought that if indeed promoters have sold in the past as well, the reaction will not be so strong. But just look at that chart. There has been a channel breakdown in Zee Entertainment, and all of this has happened post the promoters starting to sell stake. That highlight and mark, that circle that we've drawn for you at the left end of your screen shows the movement in Zee Entertainment in the last 3 days. It's lost 3%, 3% and 4% respectively over the last 3 trading sessions alone on fairly high volumes. It's broken down below a channel. Let's wait and watch if there is more downside. I'm not a technical expert, so can't quite mention with certainty whether this will happen or not, but the sentiment at Zee Entertainment is very weak. It'll be important to monitor this stock in the session today. However, what's lined up on First Word is a collection of the top editorial stories that we want to bring to you. What are the factors that will go into the monetary policy decision today? I think that's the most important monitorable. Ira Duggal will give us a lowdown as always. Jet Airways lenders want a guarantee before they pump in 1,500 crore rupees. Vishwanath Nair will tell us what's causing the delay. GAIL's costs have eased, but prices have fallen even more. Sumit Sarkar will explain the gas traders' conundrum. And then Nikki Mirchandani Johnson to tell us with the league table of mutual fund houses in India for the year gone by. Slowing growth and subdued inflation have raised the clarion call for interest rate cuts in India, and Monetary Policy Committee will announce its decision in a few hours from now. So what are the economists pricing in, and why is liquidity a big part of the mix this time? Ira Duggal reports.
India's Monetary Policy Committee delivers its first policy for the new financial year on Thursday. And if markets and economists are to be believed, it's going to be a slam dunk this time around, with most economists predicting a cut in the benchmark rate. 6.25 on the repo rate is where you were at in February. The expectation, 41 or 43 economists polled by Bloomberg, are suggesting another 25 basis point cut that would bring you down to 6%, which is pretty much where you started in August of 2017. So there will be those who will say there was a need to raise rates in the middle given that inflation was under check. Well, you can quibble about that, and yes, the RBI must take the blame for having over-anticipated inflation pressures in the economy. But as things stand, with the headline inflation number seen below 4% all the way into Q3 of the current financial year, there is room for another rate cut to 6%. Some are arguing for a stronger rate cut on the basis of growth problems, but I'll get to that in a minute. The MPC has to talk about inflation. It is an inflation targeting MPC. So even though everyone says that, the governor has made it clear that they're targeting the headline number, they will have to try and explain some of the internal dynamics of inflation. For instance, I know I sound like a bit of a broken record here, but core inflation does remain high at between 5.5% to 6%. Sajid Chinoy of JP Morgan is questioning whether headline will move to core or core will move to headline. He's also questioning why inflation expectations are so high, but there are others who say that the core inflation number will move towards the headline inflation number. So that debate, my point is, should be addressed by the MPC. They should also address why inflation expectations continue to be elevated despite such low food prices. But I suspect the larger chunk of debate this time around will be around growth. There is a lot of concern both anecdotally and in the data on growth. For the full year, you're expecting GDP growth at 7%. This is FY19. Remember, the RBI has actually not cut its forecast. They maintained a forecast of 7.4%. So one would expect them to pare that down this time around. But that's backward looking. The question is what's happening in the economy now. Again, economists are split down the middle as to how worrying growth concerns are. And even the economic indicators actually have been mixed. So, things like bank credit growth have been reasonably steady. Those are time-tested indicators of where the economy is going. PMI was looking good until last month, but the data that came in this week showed some weakening, as did cement and steel sales that came out in the the core sector data. Imports too have been weakening. Auto sales have been weak. The judgment to be made now is that how much of this is temporary. Has the economy stabilized after initial slowing, or is there, a fresh sort of cause of slowdown that is coming in, which needs to be addressed? The MPC, of course, would address this in its inflation targeting framework by saying that the output gap has widened, and hence we expect the inflation pressures to actually come off as well, and we will act basis that. So growth should be certainly a point of conversation. What judgment they come out with will be interesting to see, because, as I said, the market is split. The other point of debate, once again, is on liquidity. Again, the markets are saying that the RBI is getting its liquidity stance wrong. Now, they have been infusing liquidity all through last year through open market operations. Now they have started doing forex swaps to bring in liquidity. At the present juncture, the liquidity is still in deficit, but not a very large deficit. So the question is not so much about current liquidity, but about the liquidity framework that the RBI is using. Now, market participants are saying that the RBI's focus on the weighted average call rate is incorrect. That doesn't give them a clear picture of what liquidity looks like in the market. So we'll see whether the RBI says anything on this. This will be within the RBI's purview, so you'll likely see it in the press conference rather than actually in the MPC's statement. The reason everyone is talking about liquidity is because you can't deny that the 25 basis point cut in rates actually didn't transmit into the economy, not just through bank lending rates, but even through the bond markets, at least at the long end of the bond curve. So the old tenure, that's the 2028 bond yield, is more or less steady compared to where it was when the rate cut was announced, and when rate expectations changed quite dramatically. There should have been some impact on the tenure, but there hasn't been, and market participants are blaming that on liquidity. They're also blaming the elevated spread for corporate bond yields on liquidity, although it could be argued that there is a little bit of risk aversion that has come into the market since last September and the ILF has defaults. But in any case, the market wants the RBI to relook its liquidity framework to ensure that in an easing environment, that policy easing actually filters through to market participants and to borrowers. We'll see how much we get on that. But in terms of the headline rate, I think the general expectation is that one more cut is in the offing.
Well, thanks, Ira, for that. And of course, there are enough and more people who expect that maybe there could be more as well. So it'll be very interesting to see what the RBI says in its commentary. I'm sure a question around what the near-term outlook on rates is also coming up, if indeed the RBI doesn't sound dovish enough in the statement that comes in. Sajid Chinna, remember, is amongst the 41 economists who expect the Monetary Policy Committee to cut rates by 25 basis points tomorrow, but cautions that it may well be the last in some time to come. Today, with the core inflation continuing to remain at 6%. I think that's Sajid's view. Rajiv Malik of Macro Shanti believes that the 6-member committee has the room to cut rates by as much as 50 basis points. Hear them out.
We do expect another rate cut at the April review, just given the benign nature of headline inflation. But we need to be very mindful of what core inflation is telling us. That has been very sticky. The fact that core is at 6% tells me that there is not as much slack in the economy as we think. Output gaps are closing, pricing power is picking up. And our own research finds that over time, over a 12-18-month period, headline gradually converges to core. So I think that should worry the MPC a little bit. We do expect another cut in April, just given that the benign nature of headline and the trajectory in the foreseeable future. But I think beyond that, the MPC would need to be very careful just to monitor the signals emanating from core and to recognize that some of these year-on-year prints for growth are base effects, and we would expect that as the year goes on and these base effects normalize, the fact that growth is stabilized and maybe inching up should also be a factor.
I'd say even a bit more aggressive. So I actually think, while you rightly highlighted that a 1/4 percentage point is pretty much a done deal, I think there's a strong case for the MPC to review and go in for a bigger 50 basis point cut, even if it doesn't necessarily want to change the stance. To me, there is no inconsistency between that action and the action on the change in stance. I think Analyst, MPC itself has been slow in adjusting to the change, both globally and domestically, be it on inflation or as far as growth indications are concerned. So I do think it needs to redeem itself for having had a slow start off the block and to come out with a deeper cut.
Well, the coverage a few minutes, maybe at 11 o'clock before the policy statement comes out at about 11:30. So you don't want to miss today's policy for sure. I can tell you that. Moving on to the next piece on First Word. Jet Airways lenders are yet to pump in the 1,500 crores that they have promised to revive the airline. That's because the lenders want Naresh Goyal and Etihad to pledge part of their stake in the airline as guarantee. Vishwan Nair reports.
Lenders to Jet Airways, primarily led by the State Bank of India, are planning to seek a further equity stake to be pledged by Etihad Airways as well as Naresh Goyal to give the 1,500 crore debt support that they had promised back in March. Now remember that in March the lenders had implemented a resolution plan, as part of which they were to get about 11.4 crore equity shares from the company, which would have brought up their stake to about 50.5%, putting them in the driving seat, while Etihad and as well as Naresh Goyal would have seen their stake come down considerably, about half of what they held previously. As well as that, Naresh Goyal and his wife Anita Goyal have both left the Jet Airways board, and Naresh Goyal has also stepped down from his position as the chairman of the company. Now, this 1,500 crore debt support that was part of this plan would have been used to repay some of the employee dues as well as lesser dues which are causing planes being grounded for Jet Airways. In exchange for this 1,500 crore, the lenders are seeking more equity stake from both the partners, which will be held in a trust and will be marked to market on a regular basis. Of course, this plan is still in a draft stage and majority of the lenders are yet to approve it, as well as the lenders will need some kind of agreement from Etihad Airways as well as Naresh Goyal for them to move forward. But remember, the lenders are also dealing with another uncertainty because the Supreme Court has struck down the February 12th circular only on Tuesday. Because of the February 12th circular, lenders had swung into action with respect to Jet Airways after it had defaulted on its repayment on the 1st of January. And after that, they have been trying to implement a resolution plan within the 180-day period that was set in the February 12th circular. But now with the circular gone away, it is unclear how exactly that 180-day deadline would work and whether they would be able to value the stake that they control, about 50% of the stake that they control, at ₹1, which they had announced earlier. Now, in the absence of clarity regarding these aspects, the lenders are planning to go to the Reserve Bank of India as well as the government to seek further clarity and decide how exactly they need to resolve this case. Meanwhile, Jet Airways continues to see its planes being grounded. Just on Tuesday, it informed the stock exchanges that 5 more planes have been grounded by lessors because they have not been paid their dues. And according to an estimate by the DGCA, Jet Airways is currently operating about 28 planes on its fleet. Now, if a resolution plan is not reached soon and whether this 1,500 crore debt support is not provided by the lenders on an immediate basis, more planes could be grounded and the airline could see its entire operations being grounded.
Okay, the next piece on First Word. Gas Authority of India is in a soup, literally. The cost of gas it imports from US had fallen in the last quarter, but Singapore gas prices, which act as a benchmark for pricing in Asia, fell sharper. This leaves the country's largest gas trader in a bind. Why? Well, Sameet Sarkar is here to explain that. Sameet, good morning. Why is that the case?
Good morning, Neeraj. So if you see in the last 6 months, the Singapore gas prices, that is the Asian benchmark, have remained weak. It has fallen over 60% to close to $4.2 per million British thermal unit, and that is because of a supply glut seen in the Asian market and because of high inventory levels in North Asia. Now, because of this steep fall in gas prices, now it will be very difficult for GAIL to sell these LNG contracts at a profit, at least in the Asian markets. Now, if you see, currently GAIL has 3 active LNG contracts, 2 with USA and 1 with Russia. Now, the pricing details for the Russian contract is not available, but if you see for the American contracts, which form the major part, the pricing has now turned adverse, and that is because the landed cost of this US LNG in the Asian market or in India, that is a part of Asia, is at a premium of nearly 25% to the Singapore spot LNG prices. Now, for GAIL, the contracted price is 115% of the Henry Hub price, which is the US benchmark for the gas prices, plus a $3 fixed fees that has been charged and a transportation charge which is in the range of around $1.5 to $2 per MMBTU. Now, as you can see in this chart, last year the prices of this LNG contract were at a discount of nearly 5 to 22% to the Singapore spot prices, thereby making this contracts favorable for the company. But now, due to the steep fall in prices, these contracts are now at a premium. The prices of these contracts are now at a premium of nearly 25% to the Singapore gas prices. prices. Now, GAIL has the option to mitigate this risk by either hedging, swapping or selling these contracts in markets other than Asia. But as the company does not disclose these details, this will continue to remain an overhang on the share prices of GAIL India. Now, if you see this premium of the US LNG contract will impact the GAIL's trading business. Now, the natural gas trading business contributed close to 70 to 75% to GAIL's revenue, but its contribution on the operating income varied depending on the pricing environment in the last 1 year. For the first 9 months of financial year 2019, if you see, the trading business contributed on an average close to 30% to the total EBIT due to a favorable pricing scenario. But in Q4, this contribution could further fall or turn negative for the company because of the steep fall in the prices we have seen of the Singapore LNG prices. Now, also due to this overhang, if you see the share prices of the company, they have been underperforming the Nifty 50, that is the Asian benchmark, in the last 6 months. Now, the Nifty 50 index in the last 6 months has gained close to 10%, while the share prices of GAIL India have fallen close to 4% in the last 6 months, and that is mainly on the back of this overhang that we have been seeing for GAIL India.
Okay, Sameet, thanks so much for putting that into perspective. Literally in a bind. Not really a near-term impact on GAIL India or immediate impact on GAIL India, but something that the smart money would have taken cognizance of already. So important piece to monitor. Sameet, thanks so much for joining us and giving us that view. The last piece on First Word today is about mutual funds. Now, HDFC Mutual Fund extended its lead over other fund houses in the fourth quarter. The bigger fund houses attracted more funds in the quarter gone by, even as the overall industry grappled with the hangover of the liquidity crisis and redemption pressure triggered in the third quarter. Nikki Michandan is here to put the numbers into perspective. Nikki, how has the quarter shaped up for all the asset management companies, and has the pecking order changed? What's the AUM trend looking like?
So in terms of AUM trend, the growth is 6.1% in terms of March quarter as compared to the March quarter that we've seen in the corresponding period of the previous year. And it's the lowest growth. In fact, I was just checking the numbers, the lowest growth that we have seen since March 2014 for that matter. And despite that, if you look at the normalized rate, we spoke to a number of advisors and they said that 6% growth is actually a good number that we're looking at, given that the equity returns for the majority portion of the financial year and thereby the SIP returns were negative. The debt scare which took place, which led to a lot of redemptions, and also the higher rate of FDs, which increased the competition for these mutual fund houses. So given that, a 6% rate is a good number that we're looking at across the board sentiment. We picked up the fund houses based on the AUM and their contribution towards the overall industry's share as a whole, and topping that list is HDFC Mutual Fund, which has increased the market share in terms of AUM from 13% to 14% that we saw in the March quarter of the previous year. The AUM growth remains encouraging at 14%. ICICI Prudential was next in the list. SBI, that's a good recovery there. Market share now stands at 11.6% as compared to 9.4% that we saw in the March quarter of the previous year. That is a 30% growth in its assets. So clearly looks like there is a good amount of fund money which is growing in or coming in into this fund house. Aditya Birla Sun Life and Reliance Mutual Fund, which saw actually a decline in the market share and also thereby the returns, or rather put it across a different way, where we saw the returns going negative and thereby the assets under the management also shrinking in size for these two fund houses. What goes behind the consistency of these top three leaders is the consistent amount of money coming in from the corporates as well as the EPFO, which has led these three liquid schemes, that is HDFC, ICICI and SBI, doing well as compared to the other fund houses. In terms of the growth story that we are supposed to look at, it's Mirai, which at least we filtered this obviously the category according to the fund houses, which hold at least 1% of overall industry's AUM, and topping that list is Mirai Asset Mutual Fund, which has registered fastest growth of more than 50%. Second in the list is SBI Mutual Fund, and then we have Axis and Tata Mutual Fund.
Interesting. Nikki, thanks so much for putting that into perspective. I think a couple of 2 or 3 points that come out of this. One is SBI, by virtue of the passive money that it manages, has gotten a larger chunk of money coming in. I think some bit of the distribution strength from SBI is now coming to the fore both on the asset management business and the life insurance business for SBI, and which is why I think that fund house is being able to clock in on that base the kind of AUM growth that we spoke about. So that is one. But the interesting bit is Mire, and we had them on the mutual fund show yesterday as well, breaking into the top 15. That's quite remarkable. Nikki, just one very quick follow-up. Have any of the experts weighed in on what any of these fund houses could be doing? Well, quick 30 seconds. You spoke to any of the mutual fund advisors or the rating companies to try and figure out what is it that HDFC or ICICI are doing so right?
Yeah, it's basically the consistency of the funds of corporates in light of the debt crisis, which have paid well and worked in benefit of these liquid schemes, which typically have taken the benefit.
So HDFC has grown because of higher share of liquid schemes or money going into the liquid schemes to that company?
Yes.
Okay.
And also an EPFO money to an account to an extent has a consistent flow in those funds have helped these fund houses to perform better as compared to
the AUM growth fund at least. Okay, great. Nikki, thanks so much for putting that into perspective. So that's the pecking order. HDFC, ICICI and SBI remain the top 3 and then followed closely by Aditya Birla and Reliance. Mire breaks into the top 15 league as well, as per the numbers reported in the month of March. That's all that we have on First Word today. A quick programming note though, we talk about AMCs and what are they doing with the money. Harsha Upadhyaya of Kotak Mahindra AMC would be joining in to talk about that. We talk about the expectations from the monetary policy with fixed income expert Manish Wadhawan. And is there a slowdown in consumption? We ask amongst the largest food companies. Amul RS Sodhi of Amul will be joining in to talk about that. But after this break, a full tilt towards the day's trade.
Welcome back. You're watching IndianOpen right here on Bloomberg Quint Live. Good morning, Neeraj.
Good morning, Devina. Interesting day of trade. The good part is, though, that quite unlike yesterday's mood, the market seems to be starting off, at least SGX Nifty is indicating, it will start off on a good note, which is a positive sign, but could be a day of volatility.
Fund action turned negative yesterday, but that shouldn't be a big worry as such, because the overall trend probably, all commentary about this just being some money off the table, considering that we're at record highs now and we've seen this big run up. The trend does not get dented. It's just a matter of a day where some money's been taken off the table.
I would guess so.
All right, so Asia as a pocket is doing okay, and so is SGX Nifty. 0.25% higher for Japan. Shanghai is also up in the green, and SGX Nifty trades higher with about 23 points odd added up. Let's bring in Agam King. He's joining in now to tell us more about what happened in the futures and options space and how we're setting up for this morning. Agam, good morning.
Well, because the fact that we saw a little bit of, a little bit of a sell-off when it comes to the benchmark indices, we saw unwinding coming through in its futures. So the Nifty futures did see a decline of less than 1% in open interest. The case was the same, largely similar for the Nifty bank futures. It was, in fact, the open interest was largely unchanged. But moving on to your India VIX, that has risen further by 4%. It's now moving to the mark of 19. It's at fairly heady levels at around 19. It's not always that we see the VIX around there. This is your open interest change, and a lot of activity around the 11,900 and 12,000 calls where they were written. And on the lower end, however, we're also seeing substantial accumulation around the 11,700 mark. Moving on to okay, so let's bring up the next slide, and that's your open interest distribution. And the 12,000 mark, remains the one with the maximum open interest. This is the 25th April OI picture, mind you. And so we're working with a 500 odd point range as far as the Nifty is concerned. But let's move on and talk about your put call ratio, which has come off on expected lines to around 1.42. And in terms of stocks, which are in the F&O band, we have Adani Power, IDBI Bank, as well as Reliance Power, and Jet Airways is the one which enters the F&O band. And let's move on and talk about other stocks as well. We have, I guess I've mentioned that. Let's move on and talk about Amara Raja Batteries. A lot of broking notes coming through after the fall in detail, rather in the deal, but a lot of selling coming through. We have HPCL, a lot of weakness in OMCs. Let's move on and talk about the other one, Indiabulls Housing Finance. Watch out for this one. We've had some updates from quarterly reports. We're expecting a reaction there, longs coming through. And Marico, of course, is the other one which reacted positively towards the positive quarterly update. But mixed cues coming in, that is what we're expecting. What is really going to be most important is how the markets react after the RBI policy meet is done and dusted with.
Thanks for that, Agam. Thanks so much for putting that into perspective. So a couple of things that we want to point out. Firstly, the news flashing on the bottom of your screen, and that's SRF, the Dahej site to resume operations. Now, this will be a shot in the arm for SRF, which of course would have gotten impacted big time if indeed the Dahej plant would have stayed shut for some time, because aside of the fact that it contributes to about 33% of the revenues, it contributes to over 50% of EBITDA, and therefore on the EBITDA front the hit would have been more. But my only thought out here is that for people who might think that there could be a big uptick out here, and there could well be, we don't know how the market functions, but I don't think that the downtake was that substantial when this news came out 3 days ago in the first place, because the SRF maintained that they will go out and appeal against this and hopefully get resolve it soon. So there wasn't any downtake, and therefore I don't know what's the quantum of uptick could be, but the news is positive.
Yeah, but the day that they actually came out with the news that the Dahej plant is going to stay shut, that day there was a marginal tick on the downside, which could probably reverse itself a bit, but you may not see like a big bang move on the upside for the counter. The other stock actually is, day in and day out, you're getting more and more updates on Godrej Properties, and the stock actually made life highs, went up to about 925, 928 thereabouts. The previous high was 920. You've got them announcing yet another joint venture for Mumbai. So whether or not all of this is already baked in is something we need to watch out for, because the stock actually came off post making the highs 2 days ago, I think, is when it made its record high. So 891 on Godrej Properties is what you've got. The run-up has been pretty steep, pretty fast. Last 1 month, about 25%. Okay.
The next set of stocks, and I would request my producer to just pull up that chart of the oil marketing companies and the reaction that's come in as a result of crude prices moving up. And if you can just look at that chart too, that's the other interesting bit. I know I spoke briefly about it, but the last few days, Devina, and we'll get in our experts, of course, to talk about this, but the last few days, oil marketing companies have been on a bit of a, twine downwards. Blame it on crude, blame it on a lot of other factors, and we spoke about how the quarter would actually be reasonably okay for the oil marketing companies, the reported numbers likely, but somehow the rising crude prices have put a bit of a bind onto these companies. They've come off quite rapidly, BP, HPI, HPCL out of the Nifty as well. Not that it's a big trigger for a stock, but yeah, getting on the Nifty is one thing as well. Just the last few days have been so weak for the oil marketing companies. It'll be interesting to see what happens today as well, because crude refuses to budge. There's a supply side issue there, and those issues don't get resolved in a hurry. At least don't look like getting resolved right now if the OPEC comments are to be believed. So maybe the pressure continues on some of the oil marketing companies. Not just the oil marketing companies, the other variable also remains to be seen is what the currency does for the oil and gas pack as a whole. That too. So from levels of about 70, 73, it's come down to 68, like under 69. Gone up to 69, yeah. Gone up to 69. So that could have its own bearing, aside from the fact that you're seeing crude oil prices being firm at these levels of closer to $70 per barrel. Yes, indeed. Okay, we'll talk more about some of these stocks with our experts, but it's a good time to maybe get in our research team to talk about all the key stocks in news and some of the other factors that could impact stocks on open today. Mishika as well as Yatin standing by to talk about the key stocks that could move around in the session today. Good morning, both of you. Mishika, let's start off with you first, the stocks in news. Yeah, so the first stock we're looking at is Reliance Industries. Its arm has entered into a definitive business transfer agreement with Haptic for around 700 crore rupees, out of which 230 crores will be the consideration for the initial business transfer. The company will hold around 87% in the target company, and Haptic is a conversational artificial intelligence platform. Then we have the Q4 update on Indiabulls Housing Finance. The company says it holds cash equivalents worth 27,512 crore rupees, which is $4 billion. And the press release also stated that the CRAR as of March 31st, 2019 is over 24%, and the net carrying is at 4 times. The total resources raised in the March quarter was 17,300 crore rupees. And the company says that to deliver a 17 to 19% PAT growth in the current financial year, the company plans to raise a net total of 26,000 crore rupees in the 4 quarters of the current financial year.
NALCO's alumina output is at a record of 2.15 million tons for the financial year 2019 as compared to last year, which was 2.1 million tons. The aluminium production is at 440,000 tons versus 426,000 tons. The company says that the net sales this fiscal year will be at 11,397 crore rupees versus 9,376 crores as earnings from exports jumps to 18%. Manappuram Finance infuses 263.92 crores in its arm. The company says that it recently subscribed rights issue of its subsidiary Ashirwad Microfinance Limited to enhance its net worth. And lastly, we have Godrej Properties. It has entered into a joint venture with a developer to develop 4.25 acres of property in Mumbai. The project will offer approximately 1 lakh square meters of saleable area, and it will be developed as a luxury project.
Yeah, that's something that we were talking about. Mishika, thanks so much for putting all of those into perspective. Yatin, what has the brokerage verdict been on arguably the stock of yesterday, Amara Raja?
Yeah, Amara Raja and a bunch of brokerages. 3 of them, in fact, we have Morgan Stanley, which came out of the note yesterday. They spoke to Johnson Controls. However, post speaking to them, they still maintain their overweight rating with a target price of 1,065. They say that Johnson Controls has confirmed that the Amara Raja stake will also go to Brookfield as and when the deal, for the power solution business does get completed. In fact, they say that this should meaningfully ease investor concerns on stake sale, given the fact that Brookfield would probably like to have a long-term relationship with the existing customers and joint venture partners of Johnson Controls. Also, we have Nomura. They believe that the valuation of Amara Raja is slightly stretched at this point in time, as it trades at 20 times FY21 earnings, and it is at a 10% premium to Exide's valuation. Of course, this valuation premium, according to Nomura, is largely to do with the fact that they had an association with Johnson Controls, MNC premium, and also they had superior growth. They have a neutral rating on the stock with a target price of 824. And finally, we have Edelweiss. They have downgraded Amara Raja to a hold with a target price of 687. They do say that there is uncertainty building as far as technology in battery is concerned for Amara Raja, given the fact that there is some transition happening at Johnson Control. And also, not only that, this concern is largely to do with the fact that Amara Raja has terminated the entire gamut of agreements with Johnson Controls.
Okay, we'll watch out for this one as well. Thanks so much, both of you, for joining in. And there's, of course, the additional piece of news, as we said, on SRF. Parthiv Shah of TRACOM with us on the show as well. Parthiv, I want to start off with that news first. SRF, the Dahej plant is commissioned, again, recommissioned, if I can use that term, or starts operations essentially. So that big bogey of it remaining shut is out. Does it have a material impact on the stock price, though? Because I don't think it reacted too much in the first place when the news came out that they will not be allowed to have operations in the first place.
Good morning, Neeraj. Neeraj, actually looking at the management commentary and also the feedback at the ground level in terms of the quality of their operations at the Dahej plant, where there is zero discharge and fantastic effluent treatment. At the first place, it was a little shocking, and it seemed that, probably the pollution authorities were a little harsh in terms of having a closure of the plant. But I think probably the market got the consensus that, this is not going to last long because they have fantastic state-of-art technology out there. And eventually they will be in a position to convince without a lot of delay, because this plant is certainly very, very important. And probably if it were to stay shut for a longer horizon, probably it would have impacted almost 1/3 of the profitability. So I think good news, and probably what we saw, that stock didn't react big time, and whatever the reaction was bought into by the smart money. And SRF, I believe, is extremely well positioned for all the 3 verticals. And even the fluorine division, I think that should also do extremely well. They are having good research pipeline in some agrochemical molecules, if which fructifies, I think, can really reap rich rewards. Even their BOPP division is quite stable, and the specialty chemical division is quite stable. So overall, I think SRF is extremely well placed. They have had capex in the past, and over the next 2 to 3 years, this stock can really deliver good returns for the shareholders.
All right, that's on SRF. What's your take on the development with regards to Amara Raja now that Johnson's Control has confirmed that Amara Raja's stake will go to Brookfield? Do you think this overhang is out of the way now?
Tough one, Devina. I think this reminds me of Hero Honda days. I still remember when they decided to part ways. Probably a lot of people had written off the Hero management, the Munjals, that, without Honda's technology, how well they will innovate and do the R&D. Probably Amar Raja right now is battling the same scenario. We should not really write off the management. I think they have fantastic and very credible experience. And no two ways about it. Over so many years, they would have learned a lot of things from Johnson Controls. No doubt, Johnson Controls was a very credible name. And in fact, they are selling their entire power solutions division to Brookfield. So it's like it's not only an India-centric JV changing hands. It's more about the international division, as a result of which, due to technical reasons, even out here, there is now a comfort that the 24% additional overhang, which the market probably feared yesterday, if now it were to go to a credible private equity firm like Brookfield, I think it's nothing wrong. They can also have a lot of contacts, and probably going ahead, I won't be surprised if the Amaraja group for the battery division might have more joint ventures. Rather, one can take it that way, that being with JC, I think they would be restricted only with the technology transfers from JC. But like what we have seen in Excite, for different battery divisions, they can now have different technological tie-ups and collaborations. So I believe that, no doubt, I think the valuations have come off a lot from the highs, and it was always quoting at a premium to Excite. We might, in the short to medium term, see more like buying interest in Excite as compared to Amaraja batteries. But I would not like to write this off, because I think it's more like a duopolistic nature, and the automotive battery space and the EV battery space is a long way to go. They are also into the solar batteries and other things. So I think I would not write it off, and maybe a further 5% sort of a correction from here would make it interesting in terms of long-term investment.
Okay, 5% correction from these levels can look at a long-term investment. The Morgan Stanley is pretty overweight on Amar Raja, like Yatin already highlighted. 1,065 is their target on the counter, so looking strong there. Rahul Randeria, an independent market expert, is joining us on the show right now on the technical side. Rahul, good morning to you. Yesterday's session, just an aberration, some profit-taking off the table?
Yeah, good morning, Devina. In last couple of days, what we have seen, the rally was phenomenal, but last 3 to 4 trading sessions, we had seen that some sort of exhaustion was seen. Prices were going up, but there was lack of follow-up buying. So definitely there was some sort of profit booking happening at the high levels, but yesterday Nifty gave a clear indication with an engulfing bearish pattern forming on the daily charts as well as on the Bank Nifty. So looking at the setup, I feel that one has to try to book profits at the higher levels if there is a slightly gap up opening. In short to medium term, we have a sell call. So one can sell Nifty on rise to 11,670. Downside target would be 11,568, and one should place a stop loss above 11,742 on the spot levels. In Bank Nifty, again, one can sell on rallies to 30,240. Downside positional target is 29,781 with a stop loss of 30,487.
Okay. Parthiv, of course, take a moment to thank you for joining on the show and giving us your thoughts on the key stocks and news. Really appreciate your time. Sameet Chavan, Chief Analyst for Technicals and Derivatives at Angel Broking, with us on the show. Sameet, good having you. Thanks so much for joining in. What's your approach to trade this morning?
Morning, Neeraj. We stay with the flow, since the levels of 10,900, we were of the opinion that, the Nifty is likely to head higher. 11,500 was the initial target, then revised to 10,780, which has already been met. But we still believe that the momentum is strong. Yes, in between you would have such declines, profit booking days. But, when the trend is strong, our sense is you should keep using such dips to go long. Our sense is we are likely to head higher from current level, and we would surpass those all-time highs on a closing basis quite soon. So we would interpret this as a breather. If we look at the overall rollover activity, we have seen good amount of rollover, 67%, which is higher higher than 3 months average. If we look at their overall positions in index futures, we are seeing good bit of traction. Yes, a couple of days you would see breathers, but according to us, 11,500, 600 would now act as a very strong support. So we would use this dip to go long. 11,560 would be our stop loss level, and we would expect index retesting 11,760 first, and then go beyond to test 11,820, 11,850.
Okay, that's a call on the indices. Let's take some stock-specific ideas now. Sameet, I'll stay with you. You like Sun TV and you're buying into a Bajaj Auto.
Yes, overall, if you see, mid-cap index still looks good. A couple of weeks back, there was a breakout from its 5 to 6 month conditions on a triangular pattern. Since 3 days, we are seeing some subdued movement around its 127% Fibonacci retracement. But this is just a breather, as I said, in index also. We still focus on individual stocks. Mid-cap certainly looks good. Sun TV, which has already formed strong base. A couple of days back there was a breakout, and yesterday we saw a mild profit booking happening, but it has retested its previous breakout point. So we would go with long call for a target of around 658. Stop loss can be placed around 616. Apart from this, within auto space, there are a couple of names like Tata Motors, Bajaj Auto still looks good. Tata Motors are already moved up, and from here on also we expect a decent traction, but the risk reward is not favorable. So we'll go with Bajaj Auto, which has corrected back to its previous breakout point. So 2850, 2830 according to us should act as a very strong support, and you wouldn't be surprised to see buying emerging at lower levels. So we'll go with long call. 2980 would be our immediate target. One can keep a stop loss around 2780.
All right, and Rahul has got quite a few sell calls going. You're selling into Yes Bank, Rahul, you're selling Reliance Capital, and you're buying OFSS.
Yeah, definitely. In the Yes Bank, on the daily charts, we have seen it has seen a 90-degree rally at a stretch of last 3 to 4 weeks. Yesterday, we have seen an engulfing bearish pattern, again near its multiple resistance area, which was a pain area a couple of months back. So definitely we could see profit booking coming at the higher levels. Traders can sell in the range of 273 and on rallies to 279. Downside target 250 with a stop loss of 287. Second sell call is in Reliance Capital. The stock has been consolidating in a range, and yesterday we have seen a breakout on the downside with supported with volumes. So definitely we could see stock drifting lower from the current levels. Traders can sell Reliance Capital on rallies to 199. Downside target 172 with a stop loss of 213. A final buy call is in OFSS. After a very long period of time, yesterday stock has seen some sort of strong supportive buying seen at the lower levels with an engulfing bullish pattern with strong volumes. So definitely stock can inch up higher levels from the current level in short to medium term. Definitely one can buy on dips to 3465. Upside potential target is 3690 with a stop loss of 3379.
Okay. Those are some stock ideas that have come in from our technical experts. Just before we go on to our special segment, just one word on Maruti, which is now back at 7,000, Rahul.
Yeah, Devina. In Maruti, last couple of days we have been giving buy calls around in the range of 6,500. Our target was just around 6,800. Currently, it is quoting about those levels. Definitely, in the last 4 to 5 months, stock has failed to manage and failed to break its 100-day moving average. So I feel that some sort of profit booking could be seen, because in last 5 days we have seen at a stretch rally. So definitely at the higher levels around say 7,200, we could see some sort of profit booking. But stock is showing some sort of basing out formation. Anybody who wants to accumulate stock for a long period of time, maybe 2 years, 3 years down the line, for the investment horizon of 2-3 years, definitely one can start buying in short and small and staggered manners. It will give a positive breakout in the coming quarters, but definitely at current levels, some sort of profit booking could be seen, but that dip should be used as a buying opportunity.
Okay, on to our special segment, Bloomberg Edge, where Yash Upadhyaya tells us about a pattern that the Bloomberg terminal has thrown up on a stock. Yash, what's the stock on your radar today?
Good morning, Neeraj. So PSU banks and select NBFCs have been trading weak over the last couple of trading sessions. Edelweiss being one of them. We saw a big move on the downside in the last 1 hour of trade yesterday, and on the back of which there has been a bearish engulfing pattern formed on the charts. As we do always, let's first try and understand what the bearish engulfing pattern is. It is the formation of a larger red candle right after a green candle, wherein the body of the second candle completely engulfs the one ahead of it. The larger is the size of the second candle, the higher are the odds of it being top, and no further confirmation needed over there. In the case of Edelweiss Financial Services, what we've seen is that this pattern has formed at a mark where it has come twice in the last 6 months and has faced severe resistance. So at the mark of close to 200, every time it has managed to reach those levels, it has seen a a big amount of selling coming in. Even recently, when it tried to test those levels, it has not managed to take it out convincingly. In the bottom panel, what we have is the RSI as well. And if you look at it in conjunction, every time it has managed to, reach those levels, the RSI too has, weakened from those levels, from the overbought levels. And we've seen a move on the downside. And the bearish engulfing pattern too suggests that there could be further weakness for the counter going ahead.
Wow, okay. And how well has this worked for the stock in the past, Yash?
So Neeraj, 2 out of the last 4 times that this has happened in the last 1 year, the stock has managed to fall by as much as 5.5% over the next 1 month.
And very interesting to see what happens to this one now. Yash, thanks so much for putting that into perspective. We're just getting into this whole mode of how the situation is not as bad for NBFCs, or even if it was bad, I think some of them have managed to come out of it. And people cite the poster boys in this space, which is Bajaj Finance, to say that things are back to normalcy. But
Bajaj Finance has a different pedigree altogether.
Different pedigree altogether. This one too has managed to bounce back, and to be fair to them, I think they've done their set of attempt at repair work, right? They sold a stake in one of the businesses, got in an investor, got in funds, so got in funds as well. So in that sense, they've done reasonably okay as far as trying to mend the issues that they have at hand on the
short-term liquidity,
front.
definitely they've gotten in through that sale, and the money has come in, which caters to their capital needs for at least the near term.
Near term. I think the mistake that people could do is if they try and think that Edelweiss was at 300 during times normal, it went down to 130 or whatever during abnormal times. Now that things are looking like turning back to normal, maybe it should go back to those levels. It's not as simple as that, right? Because we do not know what the next 2 or 3 quarters will throw up in terms of numbers. Rashesh Shah, in his own words, mentioned that at least until March, things will be tough. Maybe they could be tough beyond that as well.
But to hand it over to Edelweiss, they've not had a single quarter, I think, in the last 20 plus quarters where they've reported a degrowth. They've always
those times might come now, right? Because the base is so high, because the growth trajectory has been so high, that the Jan-Feb-March quarter could well be a litmus test. I think O&D kind of managed to go by without any pressure. Maybe the current quarter will also be okay, but the Jan-Feb-March quarter and their forecast for what happens in terms of profit growth would be important. Consistently, I remember Rashesh saying that 30-35% CAGR would be a possibility. It'll be interesting to see his commentary at the end of this year about what the next year holds in store.
True. And the stock, though, around 187 right now. 3 months, just about 3% so not a very huge move as such. But that hurdle around 195, 198 that keeps coming about, putting pressure on the stock once again. The other stock is Indiabulls Housing Finance. That stock yesterday was up about 3.5% plus. In the last 1 month, has gained about 17%. Yesterday itself had a big move of about 5% odd. And their commentary with regards to their Q4 update, the profit numbers that they're going to clock in, the cash that they have in the books, their borrowing plans, everything sort of falls into place for them right now.
It almost seems as if anybody who's had a good quarter is giving out those quarterly updates. We've had 4 or 5. I don't think this has been something that we've seen in the past, unprecedented of sorts. Soba used to do that. Maybe BHEL used to do that maybe. But now we've had Godrej Properties, we've had Indiabulls, we've had Nalco, and I think we've had one more. I'm forgetting which one. So 3 or 4 names that have come out and given how the quarter could look like. But yeah, your point well taken. Indiabulls Housing Finance, fairly decent.
On the charts, Rahul, Indiabulls?
Yeah, if you look at the daily charts and if you synchronize the chart of long-term trend, September, October 2018, there has been a pain area, and after multiple attempts, this is the 3rd attempt where the stock is nearing to those areas. So definitely, it could be a very strong bottleneck for the stock to break those levels. Maybe 900, which is a psychological mark, would be a strong resistance area. But once it breaks, whenever, maybe today, tomorrow, or maybe after 10 days, it would be a trend reversal. But as of now, it has failed to cross those levels. If you look at the charts that is the area, pain area, where it has never crossed in the last couple of months. So definitely we could see some sort of profit booking at 900, but whenever it crosses and sustains about 900, we could see a takeoff, means long-term trend reversal. But as of now, some sort of profit booking could be seen around those levels.
Okay, I want to pull up the chart of Z Entertainment, and if we can just look at that stock, because while we're talking about stocks which have done well, if you can just pull that on the wall here and just then get in a view from Sameet Chavan, because and I'll just go across to this chart as well. There's a bit of a channel breakdown that we see in Z Entertainment. So broadly, this is broadly the channel that it formed. It broke through this, but that was on account of an event that happened. But largely, this has been a broad channel in which Z Entertainment has operated in. What's happened in the last 2 or 3 sessions, and that's what we've tried to highlight, the 3 big bars on the downside, and that's this week's performance for Z Entertainment. It's corrected 3%, 3% and 4% respectively. Now, I'm not a technical expert, so I don't know how important this is, and which is why we'll get in Sameet Chavan's view here. But just the price pattern and the volume pattern the last 3 days seems to suggest that there is incessant selling, which is continuing and heavy in nature. The question is the selling done? Is the price showing signs of bottoming out, or would breaking below this channel mean that there could be some more downsides to Z Entertainment? Sameet, you want to comment on this one? Very, very bad week for Z thus far. Can it worsen?
See, Neeraj, Z Entertainment was earlier, used to known for its steady moves, but ever since we saw that nosedive happening from the levels of 440 towards 300, since then this stock has become volatile, and we have already seen V-shaped recovery in this counter. But on the higher side, 480, 490 acted as a very strong resistance, and again that correction started. Due to yesterday's correction, the stock has slipped below its important recent swing low of 418, 420 on a closing basis. Thus, it confirms again a lower top, lower bottom formation on daily chart. That's a negative sign, and from here on, we won't be surprised to again see this stock heading towards, say, 380, 370, 75 over the next few days.
Okay, that's on Z. We already spoke about the 2 big gainers of yesterday. That was Indiabulls Housing on the Nifty and Maruti. Remember, HCL Tech also has not had a bad move so far. The stock has actually come back to levels of and past those levels where it had done its buyback. A few months ago, HCL Tech had done its buyback somewhere around 1100, post which the stock went closer to 1000 and even sub 1000. From there, it's been a remarkable pickup, and now past the 1100 mark, which was its earlier buyback price. In the last 1 month, the stock's gained about 6.5%, but one of the stronger players within the IT pocket. Sameet, quickly on HCL Tech?
See, honestly speaking, we were expecting a bit of consolidation in Nifty IT, and this is what we are seeing in some of the larger peers as well. But HCL, to be surprising, has already given massive move in last couple of weeks. On the charts, it certainly looks good. This week, we have seen breakout happening from its previous resistance of 1080. So from here on, we expect continuation of this optimism, wherein the stock can easily head towards 1160, 1175 over the next few days. So on the low side now, previous resistance of 1080 would act as a very strong support.
Watch out, just before we hit the pre-open, just watch out the announcement on your screen. IGL has announced the revision in the CNG and LPG prices. The stocks were off yesterday or day before because the expected rise had not come about. Now the prices have been revised. Not a dramatic uptick, but let's wait and watch if there is an impact on the stocks.
All right, 30 seconds left to go for market pre-open. SGX has lost, I think, 2 points, so nothing much to talk about out there. Marginal move on the SGX. Asia is a pocket doing okay, 0.25% higher on the Nikkei 225. Shanghai is doing okay. Hang Seng is down a bit in today's session, so just over 0.5%. It's an important day to watch out for the currency. Yesterday had a big up move. Strength came into the rupee. 68.42 is where the rupee shut shop at, and it's been the case of strength over the last few trading sessions now for the currency. So that's an important watch. The Nifty 50 there on pre-open is up about 0.5%. So 1161. It fluctuates pretty rapidly, so keep an eye out on that. Sensex also moves up about 0.5%. Gains, let's start off first with the gainers on the index, and Maruti stacks right at the top there yet again. So 7,200 at pre-open for Maruti, not bad going at all. GAIL, that's up 1.8%. Titan moves up more, so 1% for Titan, 1% for Grasim. Power Grid is up 1%. Hero MotoCorp, that's seen a good, decent enough recovery from its 52-week lows. Britannia back above 3,000 now, had breached it in yesterday's session. On the downside, Reliance Industries, 1385. HDFC Limited, that's another 0.5% that's been gained. Sun Pharma, IOC, that's in the green. In fact, the other one, that's BPCL, should pull that up. That was the worst performer on the index yesterday. IOC is up 1/3%. BPCL is flat to marginally negative. That's 363 on BPCL. Amongst the losers, and just quickly get them up, ITC, Wipro, Tata Steel, Cipla, Bharti Airtel is the one that's losing the most with a loss of about 1.5%. Just quickly looking at the currency then, from a close of 68.4 to 68.55. So a slight amount of weakness has come into today's session, early morning trade, ahead of the RBI policy announcement today. That's the rupee for you.
Yeah, well, interesting. I want to bring up 2 or 3 mid-caps, one of them being Jet Airways. The lenders have now imposed conditions of the promoters having to pledge their holding for the 1,500 crores. For now, looks like it could react, but let's wait and watch. The other one is SRF, wherein the plant, the Dahej plant is normalcy. There's normalcy of operations there. For now, again, a 4% impact. Let's see if this lasts. And just one more stock, that's TVS Motors. They had an investor day, and the commentary from the investor day was positive. Brokerages have been kind to that. 1.3% for TVS Motors in the pre-open session. That may change, of course, so let's give these rates a chance to settle down, and then we'll talk more about those. But these are the 3 or 4 names that one should keenly watch out for in the session today. And of course, we'll watch out for NALCO and Indiabulls Housing Finance because of the updates that they've given. NALCO, fairly positive updates, but the space is in a bit of a cloud, so you don't quite know what kind of an uptick will come in. But maybe brokerages have covered some of these stocks. Samit Sarkar Johnson with the top brokerage calls for the morning. Good morning, Samit.
Good morning, Neeraj. On the big brokerage calls for the day, first we have is Nomura on Small Finance Bank, where the brokerage has initiated coverage on all the 3 small finance banks, that is Equitas, Ujjivan and AU Small Finance, with the preferred pick being Equitas. Now for Equitas, it's a buy rating with a target price of 165. Now the brokerage believes that the bank's conservative approach, niche positioning in core segments and strong operating leverage potential will improve the bank's return on asset to nearly 2% by FY21. And on the back of this, they have a buy rating with a target price of 165. For AU Small Finance, it's a neutral rating with a target price of 590. Now the brokerage says that the company is best positioned among the small finance banks across most metrics, but its demanding valuations leave a little room for disappointments going forward. On Ujjivan, it's a sell rating with a target price of 315, and that is because the brokerage is concerned on the bank's strategy to gain traction through liability business. Also, it is expecting Ujjivan's return on asset to be lower compared to Equitas, and that's the reason why it values the company at a discount, and that's the reason it has a sell rating on the stock. The second we have is on TVS Motor, where Goldman Sachs has maintained its buy rating with a target price of 728, which suggests a potential upside of close to 50%. Now the brokerage is expecting the company's remarkable growth record to continue. It is expecting the company's EBITDA to grow at a compounded annual growth rate of 25% till FY21. Now the brokerage also says that the company has best-in-class execution and impeccable track record of new launches, which bodes well for the company. Now these new launches will not only help the company gain market share, but will also lead to solid volume growth as new models ramp up to full capacity. It is expecting a volume growth of close to 11% till FY21 for the company.
Well, should be interesting. Samit, thanks so much for putting that into perspective. So, well, watch out for TVS Motors for sure, because that investor day, and as Samit said, not just Goldman, I think a couple of other brokerage names as well spoke positively. I remember a comment from one of our guests when TVS came out with his last quarterly numbers that it seems to be a bit of a game changer, the quarter gone by, and the commentary from TVS Motors. With all the other auto stocks, it's come off a bit, yes, but maybe this gives it the revival and the push that it needs. I wonder if there is a trade possible out here. Fundamentally looks okay. Rahul, how do the charts look? Is there a trade possible? Is it a good time to buy a TVS Motor?
Yeah, if you look at the overall charts, and if we take it the charts to the larger degree, weekly, monthly and quarterly, the stock is basing out. It is indicating that some sort of basing out formation is been happening. If you look at the price volume action, the prices are not going down, but the volume are consistently traded on the exchanges. So definitely it indicates that some sort of volume activity and basing out formation is happening. Positionally, maybe for 1 or 2 months, if anybody wants to buy, definitely one can buy or accumulate in current levels, means from 485 to 470. Upside target for next 2 months would be around 540. It would be a positional trade, as we have seen that auto sector has been highly volatile in the recent past. So definitely we could see some seesaw. But for long term also the stock is looking good. But for anybody who wants to maybe trade or invest for 2 months, 540, which is just around its 200-day moving average resistance area, could be tested in the coming time. So definitely with a stop loss of 450 on the downside, which is a swing low, one can accumulate the stock from current levels and on corrections.
Okay, I'll keep it with autos. And Sameet, Chavan, I wanted to come to you on Hero MotoCorp, which had recently made a 52-week low. It's pulled back from those levels, but are you still seeing this as just a dead cat bounce, or there is some meaning to this move for Hero MotoCorp?
See, I would rather wait for further developments on chart. As of now, I can only say that it is trading around its multi-month, multi-year support levels. But I don't see any buying interest as such. So I would rather wait for further developments. Maybe if it crosses 2700, 2750, I can see some pattern emerging at lower levels, and then probably I can sense higher levels. But as of now, within the two-wheeler space, Bajaj Auto remains a preferred bet. If you see, if you compare all those three stocks, TVS, Bajaj Auto and Hero Moto, Bajaj Auto certainly looks good. It has already formed its base. It has already given a breakout, confirmed its short-term reversal, and has again given a pullback towards its previous breakout point. So within the two-wheeler space, I would certainly go with Bajaj Auto, which is there in my buying list.
All right. Professor, Bajaj Auto versus the Hero MotoCorp right now, 2862 on Bajaj Auto. The other one that I want to talk about is L&T. You see it breaching 1400 meaningfully, Rahul, in a big way?
Yeah, definitely.
It takes small moves. It's not a stock that will give you like a big 3% jump in a day. Stable, sustainable move. The trend keeps moving higher. But do you see that level getting breached?
Yeah, from January 2018, we have seen the stock has been moving in a very broad range of 1450 on the upside and on the downside 1200. Currently, it is just trying and making an attempt to break those levels. Even we are bullish on the stock. Yesterday's downfall or engulfing bearish pattern, in the coming days, if there is some sort of more downside, one should use that as a buying opportunity, because stock has always sustained, and multiple times it has sustained above its long-term moving averages, and I feel that maybe stock could bottom out around, settle down around the range of 1360 to 1350, and that would be the area where one can buy, because I feel that in next attempt when stock starts inching higher, because in the recent past we have seen the stock has rallied sharply from the levels of 1200 to 1430 in a very short period of time. So this is just a profit booking. So any correction from current levels should be used for investment as well as swing trade. Upside target would be initially would be 1460 and then 1500, but definitely it is looking good. The trend is also positive.
Well, let's wait and watch what happens to these names. As the pre-open rates settle down, Indiabulls Housing Finance emerges as the top gainer, and this time with reason as well. I think their quarterly updates seem to suggest that the going has been good. Titan continues to rise higher. Hero MotoCorp might be a good mover as well. Not too many stocks correcting, but for Z Entertainment, which looks like starting off on a negative note again today, 1% lower. I wonder if everything was all okay with the promoters selling stake, why is it that this time around the markets have taken due notice to this move that happened, and for the last 4 days the stock has been correcting quite strongly. There's something that doesn't quite meet the eye, but certainly it's under pressure, is the entertainment. And then Jet Airways seems to be under pressure as well. Looks like starting off about a couple of percentage points lower. As we said, that lenders have imposed some conditions on the money coming into Jet Airways, namely that Naresh Goyal and Etihad have to pledge their stake before the money comes in. This is urgent money that the airline needs. Needed. Let's see if this goes ahead or no. 5 minutes left for the markets to kickstart trade. Let's tell you all that you need to know to stay ahead in trade today. First up, as much as 90% of the loans handed out by ILNFS Financial Services have turned bad, according to the new board appointed by the government.
Lenders of Jet Airways are planning to infuse 1,500 crores in the struggling airline via debt against promoter shares. Two people in the know told Bloomberg Quint.
Reliance Jio Digital Services acquires artificial intelligence firm Haptic in a 700 crore rupee deal. Reliance will hold 87.5% stake in the company.
And moving on, Indiabulls Housing Finance in its quarterly update says its capital to risk asset ratio rose to over 24%, with net gearing standing at 4 times.
NALCO has registered record alumina output of 2.15 million tons in the financial year 19 as compared to the last year's 2.1 million tons.
And in key brokerage calls, Goldman Sachs maintains a buy rating on TVS Motor Company with a target of 728 rupees on solid volume growth prospects.
Well, it'll be interesting to see what happens to some of the stocks in the session today. The one, Devina, that continues to bamboozle hotel company stock owners is Chalet Hotels. For all the others which are not quite doing well, Chalet has been on a roll, 338 and counting, another 1.5%, and that takes the stock to fresh highs for itself. It's a recently listed stock, yes, but nothing in the subscription suggested that post-listing there'll be so much of appetite, just that the stock has just done remarkably well over the last few sessions. In the last 1 month, I think it's been a fabulous mover, 338 and counting. Not too many technical views maybe can be taken simply because the history would be limited. The stock has done exceptionally well for itself, so do watch out for this one.
It's interesting because they are asset owners, and in an upcycle, generally asset owners tend to benefit more than just the hotel brand owners. And at an EBITDA of 38%, and the management said that, they're looking to push that a little further to even push it above 40%. So that in itself is a big kicker for them. And they have land parcels, multi-purpose land parcels, which in turn will, in a way, feed into their hospitality segment as well. So all in all put together, they seem to be making a niche of their own with the kind of assets that they own, which is the bigger, the talking point right now for Chalet Hotels.
And maybe the cycle supports that business model for now. Well, let's wait and watch how that pans out. Just before we take in the top calls, and about a couple of minutes left. Yes, a couple of minutes left before the markets kickstart trade. Before we get in the top calls from our experts, just one call on Jet Airways, Sameet, Chavan. How difficult or easy it is to trade Jet right now? What would a trade be if you were to take one?
See, honestly speaking, Neeraj, we have not been recommending, we have not been tracking this counter since last couple of months, ever since this, volatile move started in this counter. Although last week, technically speaking, we saw breakout happening from a downward sloping trend line somewhere around 245, which was followed by a sharp move, and again the stock has retested those levels. See, considering its price behavior, I'm not sure whether this level will be held or not, but technically speaking, such declines toward the previous trend line support should be used as a buying opportunity. I'm not recommending, but those who have bought it, they should keep tracking this important level of 240, 238.
All right, so leaving aside a Jet, what about an Interglobe, Rahul?
Yeah, Interglobe has been on an uptrend, but last couple of days the stock has been under pressure. So definitely from current levels, and even we were given a sell call a couple of days back. So maybe 2-3% downside is there. So maybe on pullbacks in Indigo, one can go short for a target of 2-3% on the downside. Jet Airways has been highly volatile, so it is difficult to judge the trend, because we have seen that whenever we get bearish, the stock start to move up, and if we get bullish, then it start moving down. So I would avoid Jet Airways, but definitely on the Indigo, any rise, intraday rise should be used to go short.
All right, use intraday rises to go short on Interglobe. 50 seconds for market opening. Just get in those top calls from our technical experts. Sameet, I'll come to you first.
See, Bajaj Auto, Sun TV both looks good, but I will go with high beta counter Sun TV, target 658, stop loss 616.
Rahul?
I sell call in Union Bank, sell on rallies to 97, downside target 86, positional target is 86, and stop loss above 101.
Okay. Gentlemen, Sameet, Chavan, Rahul, Randeria, thank you so much for taking the time out and being with us today. Really appreciate your time. Okay, less than 20 seconds left for the markets to kickstart trade. It'll be an interesting day of trade simply because one would expect that the markets would be quiet ahead of the policy announcement. So 0.14% is what the pre-open rates have suggested for the Nifty. We're likely to start in those levels. The mid caps and the small caps too arguably will be subdued. It's a couple of hours of trading time left. Don't think that the markets would really want to do too much before that, and that's how we started off, very, very flat. I mean, it could keep on bobbing between the red and the green, not quite perturbed with that. The only thing is, before the policy, does the Bank Nifty again show a crack that we showed in trade yesterday? Let's wait and watch. The mid caps and the small caps too came off quite rapidly in the last 1 hour of trade yesterday. Let's see how they're starting off today. Again, very, very flat, so no big reactions. And I doubt that there'll be big reactions on the Nifty 50 at least. Maybe mid caps could have them and we'll speak about them. But get the heat map up on the screen and let's see what's moving and what's not. Not too many movers. That's the point that I was trying to make. HCL Tech down about 1%, BPCL maybe a 1.5%. We'll talk about the OMCs in a bit. But even Stevens on the market breadth, no big movers, no big losers at least. What about gainers? Bharti, and the stock again has been on a bit of a roll. There's been divergent moves between Bharti and Vodafone the last 2 trading sessions for sure. This one continues to rise and shine up another couple of percentage points. Indiabulls Housing Finance, by virtue of the quarterly update that they've given, is doing okay. And that aside, maybe a Titan, maybe the HDFC Twins and Reliance holding out, and that's helping the index as well, but no big gainers. It is Bharti Airtel as the gainer and HCL Tech as the loser, and maybe the steel companies which are a bit soft. So that's probably the trend of the start today on the large cap space at least. What about stocks which are in focus? A couple of them that I want to highlight. I want to speak about the OMC pack because that started off weak and has been weak for the last few days. The crude impact, and it's clearly showing at least on BPCL and HPCL. IOC for now marginally in the green, but let's wait and watch if it corrects, because OMCs have corrected the last 4 or 5 sessions for sure, but in today's session too, not starting off well. And SRF is clearly a stock in focus, but it's turning out the way we thought it would. It's not a really big reaction because when the plant closure came in, the stock didn't correct too much in the first place. Devina, what are you spotting?
A few movers. Amul Raja comes back into the green in today's session. Some clarity with regards to Johnson Controls stake sale. Amul Raja's stake will go to Brookfield now. Stock's up about 3% odd. GVK Power and Interest, smaller name, 7.5 rupees stock, but is up about 3.5%. Suven Life is at 265. That's a 4% bump up in today's session. SL Propack, which lost considerable ground yesterday actually, has bounced back in trade today, so that's doing okay. Further uptick for Godrej Properties, 2.5%. They've just gotten into a joint venture for developing property in Mumbai. Stock's up at 913. Gujarat Gas moves up 2% higher on that one. We've got Shriram Transport Finance, Brigade Enterprises 1.5% higher. Manpasand Beverages at 119, and Dish TV doesn't do a whole lot bad either. Lakshmi Vilas Bank continues to move higher. Remember, the stock has really been soaring over the last few trading weeks. I think 7 days performance should be closer to 30% for Lakshmi Vilas Bank, 30% or just a smidge lower than that. So that is good enough. The advanced decline ratio, 677 stocks advancing versus 394 stocks that have declined in trade today. So setup looks pretty okay, no one's complaining. It's a subdued start though, nonetheless.
Well, let's get in a market expert on the show. Harsha Upadhyaya, CIO for Equity at Kotak Mahindra AMC, with us on the show. Always good having him, Harsha. Thanks so much for taking the time out and being with us. Interesting times, interesting day today. Policy coming out in a few hours from now. Do you expect the policy to give any kind of bump up to the equity markets by virtue of the action or the commentary, or is it already in the price?
As far as equity markets are concerned, for the past several weeks, because of higher liquidity as well as better sentiments, we have seen markets moving up. I don't think RBI policy would really be another trigger for the move to continue, because most of the consensus expects 25 basis points of a rate cut this time around, and we think that's already priced in. And the market should not really make a big move because of the policy as such.
Okay. Harsha, what's the call though on the index at large? And divergent views coming in on whether we are overvalued or fairly valued, looking at the cycle that we are in. Rhythm yesterday was making a point that don't look at PE multiples for India because earnings haven't been trending. So if you look at price to book, I think we're still at the median and not really at the expensive end. So multiple arguments coming in. Where are you on the argument right now? And should you have the option to sit on some bit of cash while we are at record highs ahead of the election volatility? Would you do that?
Depending on which valuation metrics you look at, you could see markets trading at either fair value or fair value plus kind of a zone. Definitely it's not very expensive or very attractive at this point of time. So to that extent, I think some of the expectations already capture some amount of earnings improvement that is likely to happen next year. And also there is a hope that there will be a stable government post-elections. So given these two assumptions, market has rallied on the back of enhanced liquidity, mainly coming from foreign investors. So to that extent, in the immediate short term, we really don't see too many triggers for the markets to really make sustainable higher levels. We believe that until the elections are over, it's going to be a narrow range with some choppiness at best. And later on, depending on how monsoon comes around and how earnings season is expected to behave, then you will have a direction in the market. But until then, it could be a narrow range.
So what are you factoring in with regards to earnings, this time around? And leaving aside the approach to the markets over the next few months, as we await the election results, for the entire year, if you have to take, a constructive view on the market right now, what are the few factors that you're going to keep in mind?
I think clearly next year's earnings momentum is going to be driven by corporate banks, corporate lenders in that sense. There we are fairly confident that there will be revival in terms of earnings growth, and that would pull up overall Nifty, Sensex, or whichever basket that you look at. What is critical for next year would be there is a considerable slowdown that has happened in consumer-led sectors such as auto, consumer durables, and even FMCG of late. So whether that pocket is likely to meet analyst expectations or not will be critical for the entire Nifty basket or the market to deliver the earnings growth that everyone is expecting. If you go back to September quarter, where there was no NBFC-led slowdown for some of these sectors, the basket really grew at about 15-16% in terms of earnings growth on a year-on-year basis. If you expect that to happen in financial year 20, then obviously with the kind of strength that you would see in corporate-facing banks, you would reach closer to or to the levels of the analyst expectations in terms of financial year 2020 earnings, which is a significant 21% plus kind of an earnings growth. If there is a delay in terms of consumer-led sectors coming back to earnings momentum, then you would have issues even with corporate banks delivering better numbers. Then it will be difficult for the market to see that kind of an earnings growth. So to that extent, we are also positioned in sectors where there is a little bit of better visibility in terms of earnings. We are underweight on almost all of the consumer-led sectors, and that is the position that we will go into for financial year 2020. And as June quarter unfolds, we will review our position.
A view that we had got was that even though valuations at times are not conducive, you look at prices and you figure out whether the prices of a good company are conducive enough to start investing in. Do you concur with that opinion? Is it also time to probably look at prices being more conducive right now, and for stocks which have really not participated in this big up move that we've seen, but are decent, good quality stocks having ROCs of about 15%, stable ROCs about 15% plus, are something that you need to look at?
We generally don't follow an investment strategy which follows that beaten down stocks should be bought irrespective of fundamentals, because even if there is a pullback, that won't be sustainable, and we always look for fundamental triggers, if there are any, for those beaten down sectors and stocks for us to really start investing into. Otherwise, we generally look for opportunities where there is a reasonable degree of visibility and the valuations are on the favorable side. So that's been our approach, and we will continue with that approach irrespective of market valuations. Just because market has gone to slightly elevated valuation levels, we generally do not attempt to get into some of the beaten down sectors, because in our opinion, some of the beaten down sectors are beaten down today because of fundamental factors, and just because more money moves into those sectors in the short term, it may not mean that they will really give you sustainable returns.
So based on that rationale, areas where you do see it being more risky to enter at this point in time versus pockets where everything on those parameters that you just mentioned gets the check?
Clearly, we have been avoiding sectors such as telecom, metals, and even We have taken an underweight stance on some of the consumer oriented sectors such as auto, durables and FMCG in the recent months. Clearly, these are the pockets where the industry fundamentals have changed for the worse, and also there is intense competition in some of these sectors. There are some regulatory issues in some other sectors. So overall, it's not a clear case where you would believe that industry will get back into the old times immediately, and in some cases the valuation may also not have captured the real problems that are there in the industry. So to that extent, these are the 4-5 industry segments where we do have either nil position or an underweight position.
Harsha, just one final question from mine at least. What's the outlook on information technology? The commentary from Accenture seems to suggest that Indian companies could benefit too. Today the index is the top loser. The currency has been strengthening, and maybe that has that sentimental impact too, even though we know that over the long term fundamentally companies hedge themselves well enough. But what's the growth outlook looking like, and would you be bullish about the prospects?
IT sector by and large should deliver market performer kind of returns in our opinion, and in terms of business the momentum has improved compared to 2018, but as you rightly said, there could be further pressure on margins because we are unlikely to see rupee depreciation this year. Compared to 2018, I think a lot of things have changed for IT sector. I mean, when you go back and see what happened in 2018 and why there was such a big rally in IT stocks, clearly a couple of factors helped. One, there was an under ownership in that sector from across domestic as well as foreign investors. You had rupee falling from higher levels to lower levels during 2018. You also had the market earnings growth failing to meet analyst expectations. In that scenario, IT actually delivered better than market expectations. And more importantly, for 3 to 4 years before 2018 beginning, the IT sector had not really performed well. So all these factors led to kind of a supernormal returns in 2018 for the sector. And when we get into 2019, some of these factors are no more there. For example, we don't expect rupee to depreciate the way that it depreciated last year. There is significant amount of ownership in the IT segment today. In terms of the earnings growth rates, it is unlikely to beat market earnings growth. So given all this, I think at best it will be a market performer in our opinion.
We'll leave it at that, Harsha. Thanks so much for taking the time out and joining us. Really appreciate your time.
Thanks, Neeraj.
That's the view from Harsha Subramaniam, Harsha Upadhyaya, excuse me, of Kotak Mahindra IMC. Let's slip into a short break. We come up and talk about the policy expectations with fixed income expert Manish Wadhawan. And then, is there a slowdown in consumption? We pose that question to Mr. RS Sodhi of Amul.
Welcome back. You're watching Indian Open. The third quarter GDP data showed an undeniable slowdown in India's economic growth. High-frequency indicators like PMI, core sector growth, import-export data, and consistently weakening auto sales have only increased the concern. With inflation near the lower end of RBI's target range, there's reason and room for the Monetary Policy Committee to cut interest rates. At least that's what a Bloomberg poll indicates. 41 out of 43 economists polled by Bloomberg expect a 25 basis point rate cut today. There's also a question of aligning policy rate with RBI's liquidity stance. To talk about all of the expectations going into the first monetary policy of this financial year, we are joined by fixed income expert Manish Wadhawan. Manish, thanks very much for taking out the time. Firstly, are you also in the camp that expects a 25 basis point rate cut today? And more importantly, do you see a change of stance from neutral to becoming a little bit more accommodative in line with what we've been seeing with other central banks?
Yeah, morning. I think you hit the nail on the head in the morning when you said there's a lot of data which is pointing out towards this cut today, and I think there's a complete consensus on the street that there would be a 25 basis point cut at least. I think the realized inflation has underachieved for the last 6 months to something like a year or so. Inflation projections for the full year are quite low, around 4%. That leads us to believe that, yes, I also agree with that, there's going to be a 25 basis point rate cut. I do not expect the stance to get changed today. I think they will stay neutral, but I would add on a very important factor, which is, which I'm expecting in policy. I think the focus would move or shift towards transmission. One of the most important steps what we have seen from RBI in the last 1 month or so is the dollar swap window which they opened. It has had amazingly positive impact on a lot of transmission channels which were required for India. First was, importantly, the hedging cost for borrowing in US dollars or foreign currency has come down by something like 80-90 basis points. Plus, it has added liquidity to the market. And finally, it has also helped in bringing down the credit spreads in the corporate bond market. These are all the three very, very important unintended and intended consequences of this US swap, which RBI conducted, and they have announced it for the next $5 billion this month also. So I think two things will happen. One is the rate cut, which will be definitely very, very important in messaging. But the other important thing would be the transmission. And I'm expecting, I think, maybe some more ideation from RBI on how do they announce or how do they implement this cut into lending rates.
Right. According to you, the previous rate cut that we'd seen of 25 basis points, the transmission of that, has it flown into the system? And the other point being, you said that the corporate bond spreads have been coming off slightly. But the other part being that the banking system's credit deposit ratio still remains more elevated. NBFCs is still a little bit more reluctant to lend. So has the liquidity been absorbed well into the system, or there's still, that gap there?
So what has happened is RBI has actually provided a lot of liquidity through OMOs. Yeah. And I think when they at this point of time, on a prudential basis, when it was realized that beyond a certain point of time, buying of government securities by RBI may not be of any use, at that point of time, I think they moved on towards the swap window, what we talk about. And this swap window has, given a lot of fillip in terms of bringing down the cost of corporates for external borrowings as well as the domestic borrowings. There have been also an additional factor which I would use in terms of pre-election currency expansion, which is also responsible for this liquidity tightness. I believe that as the elections gets over, you will see some kind of normalcy returning in terms of currency expansion, and therefore the liquidity would become better in the banking system, in addition to what RBI is doing at this point of time in terms of the US swap window. So, a combination of all the factors, in my view, would lead to a far more better liquidity in the next quarter, 2 quarters or so, and you can see the impact, and you will see the impacts in terms of lending costs also. Second point, what you made about the deposits and the credit growth. The credit growth has been actually quite robust in the last 2 quarters. I completely agree with you. It's growing around 16% per annum on a Y-on-Y basis, and deposits are growing around 11-12%. But I think that is just a catch-up which is happening because a lot of credit demand has moved towards the banking system from NBFCs. And as RBI is, liberalizing the ECB norms and the hedging costs come down, you would see even NBFCs borrowing more in the system and then coming back to a bit of normalcy, and when they start expanding their book. So in my view, I think the worst in terms of liquidity is already over. We will see some more measures from RBI to aid additional liquidity in the banking system, and that should be helpful in the next 1 or 2 quarters.
What do you think these measures could be like in terms of the guidance that the RBI could provide with regards to liquidity particularly?
So if you look at three or four factors, number one is rate cut expectations, which should materialize today. As you said, 41 out of 43 economists are looking for a rate cut.
Second thing would be the liquidity. I think they are providing ample liquidity to the system, and as soon as the March is over and we get into April and May with government spending and also with these measures what RBI have taken in terms of OMOs and these swap windows, which I expect to continue because there is anyway a dollar surplus in the system at the moment which would get absorbed and release rupee liquidity. I think third important thing is the changes which RBI is getting into in terms of transmission in form of what kind of benchmarks to be used. We have seen one of the largest state-run banks coming up with the repo lending and borrowing linked to repo rate, which is the direct transmission mechanism which would happen. So I think all these factors, surplus liquidity in the system, rate cuts, and also the kind of benchmarks what we use, which shall translate into some kind of reduction of cost of borrowings for the borrowers. These are the three pillars which RBI would work upon, is my assumption, and we are already seeing all the steps in these directions. I really don't have an idea what could be the other measure, but there is no emergency at the moment, there is no crisis at the moment, so these measures will definitely impact in the next 2 quarters in bringing down the rates across the board.
Manish, morning, Neeraj here. How much weightage do you think the MPC will give to growth? While you spoke about bank credit growth looking steady, PMI is weakening, the high frequency indicators, auto sales, I would probably even include the air traffic growth is showing signs of moderation, core imports are weakening, global growth is looking weak. Does that weigh in on the MPC's thoughts currently?
Neeraj, definitely I think these factors would weigh in at today's MPC. As you pointed out yesterday only, we heard from the IMF chief even reducing the global growth further and saying that the global economy has got into a weaker mode since January. Lower inflation, as you said, lower PMI and the export numbers also. But I would have a caveat here, even if you say sector specific, the car sales are down or automotive sales are down. We have seen a trend before every election, the quarter before the election, there is a mild slowdown in the economy as the decisions get put off. This is evidenced by data, if you look at the earlier elections also. So, it's not something that we should be just taking a very, very negative picture on growth at this moment, because there is an antidote in terms of the demand for funds by the industry is growing. The retail book is growing quite fast. If you look at as we said, the credit growth, it has been the sharpest in the last 5 years. So, is growth not there at all and still the industry and the consumer is demanding for credit? I think there are mixed signals here. My view would be that this is an exceptional quarter, what we are looking at in terms of domestic data. Always pre-election data has been quite soft, and there would be some kind of a balanced growth numbers which we would see for the next 2 quarters. So these factors will play a role. I think they've already been factored in when we say a 25 basis point rate cut, but growth falling very, very sharply doesn't, I think that is not the outcome we are looking at this moment.
So therefore, you would be believing that there will be a 25 and a commentary which will be balanced, or a 25 and a commentary which indicates that there could be a further 25, because the split is right down the middle, equal and enough number of people thinking of both the options currently.
Neeraj, I think I would stick my guns to a 25 basis point rate cut with a soft commentary only. No, there's no doubt, because there is no inflation at this moment. But I do have doubts about it, that it would give you some kind of a future guidance of further rate cuts. I have my doubts about that. It would be left as data dependent, and we see it from here how it pans out. So I don't expect in today's policy that MPC would give a timeline to further rate cuts also. It would definitely be a rate cut. It would definitely be a soft stance, what we talk about, a neutral stance with a softer bias. But giving a timeline to further rate cuts, I have my doubts that something of that sort is coming today. It would definitely be saying that it is data dependent, and the way it pans out, we are here to support growth. So to your point, to conclude that part, I think inflation has achieved, the realized inflation is quite low. It is below the target of RBI at this point of time. So rate cut is a given here. Second thing is transmission. Third thing is data dependency, and finally on liquidity, I think there would be far more focus. I really, there can be enough number of tools to provide more liquidity, but at this point of time, if liquidity is becoming comfortable for the next 1 or 2 quarters, they might continue with this swap window, which is an excellent tool at this point of time in their toolkit.
Right. Manish, just to conclude this conversation, how closely are fixed income investors watching out for this, and what happens to bond yields now currently at about 7.27, and also for currency watchers, with the kind of moves that we've seen on the currency on the stronger side over the last few days?
Yeah, so on the bond yields, I think a lot of it is factored in today in terms of the policy rate cut. A lot of expectations are already factored in. If you look at the swap curve also, it is factoring in at 25 today. Actually, swap curve is factoring in 1 more rate cut after this. As far as the long end yields are concerned, I think they have factored in this 25 basis point cut. But there is an antidote in terms of there's a huge amount of supply which is going to hit the market because there's a large borrowing program which has been announced by Government of India. So it will keep the yields at the longer end a bit in check. So one should not expect a massive rally from here at these levels in the long end bonds. And the short end bonds have already adjusted quite a lot. So I think trying to say that markets have factored in today's rate cut quite a lot. It's priced in quite well. And unless and until there is a surprise of a 50 or some kind of a guidance of, as Neeraj was pointing out, if there could be a guidance for further rate cuts, then you could see a further fillip. But definitely the bias is positive at this moment on interest rates. It is also being aided by the world developments. If you look at what has happened in the developed world, 1/3 of the bond yields across the world have gone into negative again, and there are clouds over growth. We've seen a sharp rally in the developed world bond markets, and whether it is US or Germany or Japan, across board we are seeing yields coming down. That would definitely also play a role. Finally, note on the currency, I think with the last change of stance by the Fed in terms of that there may not be any rate hikes at all, we have seen the EM currencies strengthening, and so has rupee also. Dollar has weakened across the board, and finally with the swap window getting announced by RBI, it has added more fillip to rupee. So I think with all these things continuing, you might see a phase of strong rupee for some time, maybe a quarter, though there would be a time where in April and May there's a strong demand for dollars which come up, which is seasonal, and yields remaining soft here, and there is a possibility that yields might actually go lower over the period of 3 to 6 months.
Manish, leave it at that. Thanks much for taking the time out and being with us today.
Thank you, Neeraj. Thank you, Devina.
Well, that's on the policy. Take a break. Slowdown in growth is one of the main reasons for such a strong call in interest rate cuts. Is that reflecting on consumer sentiment as well? We ask RS Sodhi of Amul. That's coming up after this break. The talk in the market is that consumption is slowing down. If not slowing down completely, then there is some bit of demand moderation, and that customers have also started down trading. There are hints of this at least visible amongst conversations that we have with companies. So we thought it's best to speak to one of the largest food brands in the country to try and get a sense of not just what they are seeing in their business, but of what they are seeing across the consumption spectrum. Joining us now is that very gentleman, Mr. RS Sodhi, the MD of Amul. Mr. Sodhi, so good having you. Thanks much for joining in. Now, when we see reports from brokerages who talk about what their channel checks are suggesting, almost unequivocally, everybody is saying that demand is starting to moderate across product categories. Now, you would be the final word on dairy, but I would want you to start off with what your thought is about demand and possible demand moderation across the staple space.
No, I don't think demand is reducing, but what can we say is in some categories there may have been a reduction in the growth rate. What we used to get in earlier 3-4 years may have reduced, but it may not be true for packed branded food products. You see, food market in India is around $300 billion, and dairy it is $100 billion, pack branded is only in dairies $100 billion and another $100 billion in other food products. So what is happening is demand, what we have found is now coming for branded food product is more from the rural and tier 2 and 3 or smaller cities also, or I say bigger villages also. And what is happening is we find tremendous increase in demand for the small packs, 5 rupee pack, 10 rupee pack or 20 rupees pack. We have seen now people are consuming or buying less of bigger packs and buying more of smaller packs. And earlier we used to give a very good bargain to the people for going for a bigger pack. But now I found that brands have started giving bargain for the small packs also. So naturally, consumers find it better to buy a smaller packs, and every time you can buy a fresh product instead of keeping in the house on shelf for 1 month or 2 months. So as such, in dairy, if you ask me, in all fresh product, whether it's a milk or buttermilk or dahi or paneer, the volume growth is double digit, year-to-year basis. And out of a double-digit growth, half of it is coming because of increase in consumption. Because if prosperity, income levels are increasing, people are spending more and more on the food. And half of the growth is coming, people shifting from loose or unpacked or unbranded to the packed and branded form. So for food in packed and branded, demand is growing, but more diverted towards smaller packs.
Interesting. Mr. Sodhi, why would companies be undertaking such a strategy? I would presume that more packaging, because by virtue of smaller packs, would mean higher costs. And I'm guessing it's not an innovative strategy because it takes probably a month for competition to catch up when somebody would launch an innovative packaging or a marketing scheme. So why would companies be doing this in the first place?
See, if you don't do it, somebody else will do it because there is a gap. If suppose I'm selling a dairy whitener in 200 gram or 500 gram packs, and which is costing around, for 200 gram is costing around 65 rupees. And if in the smaller markets, if I'm selling X packs, if people want smaller packs, somebody will launch 5 rupees or 10 rupees pack, and people who cannot afford 65, they'll start buying that pack. So if I don't do it, somebody else is going to do it. And I have found in 5 rupees and 10 pack, we expand our capacities, and always demand is ahead of the capacities what we expand. And nobody wants to give that market to somebody else. And in ice creams also we have found 5 rupees, 10 rupees pack, because now no longer branded packs or even the premium products like cheese or like ghee are only for cities only or urban consumer. Rural consumer also want to buy the same product but in the small pack size. And in urban areas also we have found people have started buying more frequently but smaller packs.
Interesting.
And food, because you get fresh product every time you buy.
Sure. Okay, so this food market, and you spoke at length about how the rural market is starting to pick up. May I ask you that in your 13% growth that you witnessed in the year gone by, has the proportion of rural growth, the additional revenue coming in through the rural market upticks, been substantially higher than the past and higher than what you had envisaged? And if that is indeed the case, would you believe that's a trend that is developing now?
No, please try to, when I say rural, does not mean the rural per se. Rural means lower end of the market. It is present in rural India also. In the bigger cities also, smaller slums area or the lower income group markets. So that is the market is growing. Especially some states, I give you example, like some state like Bihar, Jharkhand, Northeast, these states are giving us much more growth than the metro cities.
Okay.
So now these are Delhi, Bombay, Calcutta, these are the mature markets. Competition is also more. But I have found in branded food products, tier 2, tier 3, markets or the states are giving much more growth than the already developed or the mature markets or the cities.
Very interesting. There were some murmurs of down trading in certain pockets, Mr. Sodhi. You know, brokerages who have come to us have said that when they speak to companies, they are talking about some moderation in demand, not all. You yourself said that demand is not moderated, just that people are opting for lower price packets. But, you know, across industries, plywood, certain staple companies, select auto companies are all saying that, at least to those brokerages, that there is some bit of down trading that the Indian consumer has started to do, which is the first time that they believe they have seen this in a really long time. Have you experienced that? Have you heard of that? And would you think that this is just a passing phase, or could this be the new normal?
Well, you see, people who are charging some premium for any product category without delivering the value, their consumer is realizing that I'm not getting the value equal to the money I'm spending. And with the choices increasing, people are going more for more value for money or economical products. So one fellow will call it down trading. Other fellow is saying that I'm buying what I'm spending. So what I found that consumer is becoming more smarter and wise when making choices. They will not give you the premium just if you have got a fancy packing, or they'll give you 30-40% more for the same product just because you have got a big brand. So now if you want to take any money or 10 rupee out of a pocket of a consumer, you have to deliver that value, because now consumer has got more choices. And here I'll also like to do down trading. See, earlier I'm talking about more food, which may be applicable to a lot of other FMCG products. Earlier, consumers were giving premium or expecting that national brands are good. They were ready to give 10%, 20%, 30% premium. Then came in food regional brands. So consumers started buying more of regional brands because they found it is good. But now I found there are city brands. Now consumer is giving more preference for the city brand or the mahalla brands or the regional brand than the national brand. And these brands, which are regional brands, are naturally more economical and giving more delivery. So those national brands feel the consumer is down trading when they are switching over from national brand to the regional brand, but which is not true. Consumer has become more smarter and wise.
Has there been an increase in promotional intensity for the same basket of goods, Mr. Sodhi, in the food space? And if you can throw some light on how the last quarter or the last 6 months, how pricing and costs has been, maybe from an Amul perspective, maybe from an industry perspective.
See, one thing is, it is now becoming day by day very difficult to build national brand or to maintain national brand in food. Because firstly, with your media, which is becoming day by day very confusing, you don't know where to spend. You want to increase on TV, people are shifting to the Netflix or Prime Video, etc., the youngsters. And people are on social media more than on the press, etc. For national brand, it has become extremely difficult. So I don't think now for any even national company, anybody can build national brand in 1 or 2 years like they used to be earlier. By just spend 40, 50, 100 crore rupees on the TV, you can make a national brand. That has become very difficult. And also the distribution cost is becoming too much. And coming to the second part you said is last quarter or two thing. What you said is?
Yeah.
What was the question?
How is the pricing sitting and how have costs been?
Yeah. In food or in other practically there is no increase in the pricing or the MRP or the price to the consumer last 1.5 to 2 years. I'm talking about food and energy, because the input costs had not increased, whereas competition has increased. So practically there's no way to increase the prices. And cost of production also more or less there. Whatever impact of GST had come in most of the FMCG product or food products prices had reduced, except in case of dairy, if you talk ghee price increase, but most of the other products prices have reduced. But now, after this 2 years lull in the market, no price increase, now gradually cost of production of food products is increasing, and you will see next 2 years food products prices will keep on increasing day by day.
Okay. Well, that's not music to the ears. We want lower food inflation, maybe not as low as it's right now, but lower food inflation nevertheless.
It will be, it will not be more than the inflation, but last year price was below inflation.
Would it be safe to say that you believe that a volume growth of 10 to 14%, whatever the number may be, 2/3 of 20 essentially, but 10 to 14% could be achieved by Amul, yes, over the next 5 years, but the industry too could have reasonably sized growth, because I don't think a company can really outpace the industry by a wide margin. So if you grow at 14, maybe the industry grows at about 10 or thereabout percent. Do you think that's a safe assumption?
What I said is industry will grow at 14% volume. Amul is trying to match the same. If we don't grow, others will grow and we lose the market share. So we have to grow at 14-15% to maintain our market share, because we are the market leader in most of the categories. Consumption is going to grow. So if we don't make our policies, our marketing strategies to match with the growth, somebody else will snatch our market share. So we have to grow.
Okay. Mr. Sodhi, fabulous chatting with you. The reason why we thought of this is because a quote that came in from you that 37 years ago when you joined Amul, it was a turnover of 121 crores and now 33,000 crores. It's been a fabulous growth journey. Hopefully, the next few years are even better. Thanks so much for taking the time out and speaking to us today.
Yes. Thank you, Neeraj. Thank you very much. Nice talking to you.
Pleasure.